Crypto markets give back gains after the Bank of Japan signals a potential rate hike this month. The Fed is set to cut US rates next week, and a wave of liquidity should be coming into the new year. Crypto volatility falls back after last week's spike, and PutSkew loses some of its panic bid. All this and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran Lakha from Options Insight. I've got my man Dave from FRNT. How's it going, man?
Yeah, I'm good. Yeah, yourself?
Just you and me today?
Just the two of us.
Yeah, it's just the two of us.
I don't sing. Oh, my God.
Come on, we're getting into the Christmas spirit, right? Karaoke, things like that. We're not that far off now.
It's not, but it'd be nice to see a Santa Claus rally in crypto, wouldn't it?
Doesn't feel like we're going to get it, though, does it?
No, it doesn't. It doesn't. I mean, like we had a good week last week, right?
Yeah, I mean, it's kind of like crypto was lagging stocks, and then they had that final push into Thanksgiving, and then crypto woke up a bit as well. Yeah. But God, it was fast to give it back yesterday.
Yeah, and I guess everyone's worried about Bank of Japan, and
so is that the main trigger? You think
it felt it? I mean, when there was nothing else really going on, and then like the headlines kind of came out.
So go and walk us through that then. Yeah,
so essentially, Bank of Japan alluding to the fact that they're going to need to potentially hike rates this month.
But why does crypto care so much about that?
Yeah, I think everyone just flips into the carry trade unwind. I think everyone's a little bit scarred from August last year, if you remember, when everyone was talking about the carry trade unwind.
Okay.
And just obviously Bank of Japan hiking rates, JGBs were selling off. I think like 10-year Japanese yields now, like I think they're highest since 2008, basically, which obviously was a scary time for markets in a way. But then there's the fear, then the contagion, then to global bond markets, and then everyone keeps talking about this carry trade unwind, i.e., there's a leverage. There's a couple of nuances to this, right? Because there's a leverage trade where people borrow cheap in yen because rates have been low to then invest in riskier assets. But I actually think, and this is why I've got quite a nuanced take on this, because I think what people are talking about, and I think they get wrong, right? And why I think there is no carry unwind is there's circa like $4 trillion worth of Japanese assets invested in foreign assets. So
Japanese funds invested in foreign assets.
Yeah, and the fear is that as domestic rates go higher, then a lot of those funds will be repatriated back home to earn the higher yields back home.
Right.
So that's kind of the fear, and then so therefore they're going to sell all their foreign assets, and it creates a big dump of foreign assets. And I think that's the carry unwind that people allude to. Now, and obviously we saw in August last year actually a big dump. So I kind of think like the algos and everything just trigger and sell risk on the back of it. We still obviously like crypto's still got this weak side that
because stocks didn't fall that much.
No, they like came off a percent,
but then they bounced to 50 bips by the end of the day.
Yeah, exactly. Right? They sort of spent the rest of the day clawing it back.
Yeah.
Now I think part of that is because, as I've said before, I still think markets are underweight equities. So markets basically sold everything in April, and then we climbed a wall of worry, and we've really just like ripped to ever new highs. And I think a lot of funds are actually underperforming their benchmarks, are underweight, so they're having to buy every dip, and they're just constantly trying to reweight higher. So I actually think equities into Christmas we will see the Santa Claus rally, because I think everyone's going to chase performance into year end because of the positionings offside. Bitcoin and crypto, I guess, is kind of the other way, and like because you've seen this supply dynamic of wows and whatnot. We spoke about last week, all selling. You've had the demand destruction after that, the 10th of October liquidation event. So I think the demand supply dynamics in a way are different in crypto, and the weak side is still kind of to the downside. So when we get these little kind of risk off moments like we had, the bid gets hit, and then it's harder for crypto to recover. Whereas I think equities, there's just natural buyers on every dip at the moment because people are underweight and they want to reweight higher. So
there's a lot of chatter going around about FUD around Tether and like MicroStrategy.
Yeah.
Like being tested, like how low can they get it if they can like force him out of some of his
I mean,
holdings.
it's funny to me because like the Tether FUD in past cycles is always like, for me, that's a bottom signal, right? Everyone's FUDing Tether again. I thought that had just died and gone away because like, it's got to be one of the safest businesses in my mind out there. So it seems ridiculous.
They print Tether into existence. So so the story is, what's the FUD? That they print Tether into existence out of thin air. They buy crypto with it. They don't have anything to back that Tether that they've just printed. But then when they make money, they basically then they monetize some of their gains and then they park it against the Tether that they created. Is that right?
I mean, quite simplistically, the big FUD is that it's not backed by the assets. They've not got the assets to back the actual Tether.
Yeah.
And in the latest like attestation, they've now started to also like predominantly own treasuries, right? But now they own gold and they own Bitcoin and other things. And so I think the latest FUD was looking at the assets and versus like the liability side was that if the value of Bitcoin basically went to zero and gold collapsed, and the thing like they would not be backed one for one. And they could potentially go bankrupt. But again, obviously the Tether guys themselves sort of came out to dismiss that because it's not taken into account like their equity, their monthly cash flows, all these other things. I mean, my kind of view on it is, and I know that Arthur Hayes was out like fudding on it. I don't know what his game is, but I just think he's completely got this one wrong. Obviously, if you looked at banks, if you looked at the state of a bank balance sheet, you'd shit your pants, right? Like you really would, for want of a better phrase, because you'd be really.
It's
really
about leverage
concerned.
ratios, isn't it?
And the difference, obviously, of a bank is the banks implicitly have the backstop of the Fed,
whereas Tether doesn't.
And you feel politically there'd still be a lot that would like to see Tether foul and the crypto space foul, but they're one of the biggest non-sovereign holders of treasuries. Ditto for gold. Like I honestly, if you're worried about Tether, it's ridiculous. Like in my view.
Okay. And what about the Saylor FUD in terms of they're trying to test his liquidation levels?
Yeah, but
I mean, he's out there claiming that he doesn't have to liquidate until Bitcoin goes to like sub 1,000.
Yeah, and now
I don't know if that's true.
And now he's raised the dollars like to basically like pay out on the dividends and all that stuff, and the preferences. So again, I do feel like that's more of a risk in the market generally. Like if I was worried about anything, it would be that. But again, it feels like that can's been kicked way out into 12, 24 months, whatever cash he's got on hand now.
I wonder if his premium if his NAV premium will ever go back up again to anything like what it was before. I doubt it will.
And that's the FUD now that he might start selling the Bitcoin to buy back the stock, which I think Saylor's a smart enough guy to know that you then trigger a cascade of like you'll then see Bitcoin come lower, your share price will come lower, which means you need to sell more Bitcoin and you'd be on a death spiral.
Yeah, it would be stupid.
Yeah, I like that for me would be like a genuine fear, but I think Saylor's like too smart to know that he's not going to trigger that event. But that I think that's a bigger risk. Tether for me, not at all. Like honestly, it's just it would. Yeah, they could withstand such large withdrawals, and again, you're talking about if Bitcoin basically collapsed to zero and gold and everything tanked, like then you've got a problem. But
it's interesting. Like Circle, obviously the issuer of USDC, right? That has been smashed. Have you seen the Circle stock price? So they IPO'd at like 30.
Yeah.
They rallied to like 300. And now they're back down to like $80. They got as low as like 60, 65. But they're about 80. I think, no, they might be about 70, 75 now. So they've come down a long, long way.
Yeah. I mean, like,
I high beta to this crypto sell-off.
My thing around Circle is, like, for me, essentially it's a short duration play when I think of it, because they're so exposed to the rate environment. So if rates are coming lower, then profitability in my mind should come a lot lower. So it makes sense if we're going into more rate cuts that like I wouldn't want to be long that stock. But again, and I know there's offsets to that, and as they expand and whatnot. But in my mind, being long Circle is almost like being short duration, i.e. it's essentially, it's almost like a play on that rates are going higher, and obviously we're in a rates coming lower.
So you think Circle will make more money if rates go higher?
Yeah, because essentially again they're parked cash in treasuries essentially.
Yeah,
so
yeah.
If those yields are coming lower, then
they make less money.
comes lower.
Okay.
And then look, obviously the whole space has just seen, has been under pressure of all kind of crypto companies, miners, everything that's been under pressure. So that is what it is. Going back though to this kind of carry unwind fear. So like where I really push back against this, right? I've worked in the past with like the big Japanese life and pension funds, right? That's where the big domestic money comes from, and that's invested abroad. These guys are so slow to change their portfolio allocations. And in fact, they rarely ever do it. Like they rarely ever touch them. What they do often do more actively is adjust their FX hedges. So they adjust and to adapt their FX exposure. But in terms of the idea that they're going to start selling out of all their US equities and bonds to bring back home just to pick up a few extra bips, I actually think there's and I put out earlier on Twitter, I actually think there's an argument to say that actually, like, Japan's in a really bad place, right? They've got a proper mix of, like, proper stagflationary mix.
This is something my friend Greg Magadini talks about a lot. And how, like, their currency is just going to go down the toilet, basically. Yeah. So and everyone's thinking like we're going to see this big like short dollar yen trade. I actually would be more biased to dollar yen going like higher, like to like 200 over the next year, I would say. And the reason being is that they're really stuck between, so they've got inflation, which actually is largely being driven by rice prices in Japan, but and at the same time they've got like negative growth. So they've got proper stagflation. They're needing to hike rates to address the inflation element. But then this is a country with like debt GDP like north of 240% or whatever. Yeah, it's the high. Is it the highest?
Yeah.
Out of everyone.
Yeah. And so they're obviously then exposed if yields start to go higher and the problems that causes. So they end up being faced with this really strange situation where they're hiking rates. Japanese bonds are selling off and yields are going higher, and then the Bank of Japan have already said they will intervene to like essentially smooth any sort of bond volatility, which means they're going to then be printing money to essentially buy back bonds. Yeah. Which is, and they're going to have to control that yield curve. And they're going to have to essentially.
But don't they own most of the bonds themselves?
They do, yeah. But there's still enough out there that can cause them like trouble. Right?
At some point, there's going to be no seller.
So they're going to end up owning even more of the bond market, right? Which is going to then kind of contradict what they're doing in trying to tighten, because then they're going to simultaneously have to be printing money to essentially buy up the bond market to control yields, and that's going to put the currency under pressure.
Yeah.
So essentially, for me, they'll have to choose between the bond market or the currency, and the choice will be the bond market, and they'll let the currency go.
Yes.
They've also got a problem at the moment, I think, with the new PM has basically pissed off China by saying about how they want to defend Taiwan. If you remember, Nancy Pelosi in 22 annoyed China by going to Taiwan, and the US Treasury market came massively under pressure. So China will weaponize the bond market to say, like, you be careful what you're doing. I think they're doing that to JGBs as well. So I think Bank of Japan are going to have to potentially intervene and be buying up their own stock bond market again, and increase sort of bond purchases. That's going to weigh on the currency. And contrary to this whole idea that we're going to see this reverse carry trade where everyone's going to sell, say, foreign and predominantly US assets to bring it back home, I actually think it's going to accelerate the money domestically wanting to leave Japan and go elsewhere. So I actually see a scenario where what's going on would accelerate outflows from Japan into the US, and that'll be good for NASDAQ, and ultimately as well,
so what you think,
good for
you
Bitcoin.
Think domestic Japanese people will look at the risk to their currency and want to move it into things like Bitcoin or things like the dollar to preserve the purchasing power.
Because they're hiking rates for what I call like the wrong reasons. They've got stagflation. So there's no one in Japan that are going to be looking at it going, oh perfect, let's bring the money back home. They're going to be looking at things going, this is a mess, and this is an unsustainable mess. And ultimately, they're going to choose between the bond market or the currency. But either way, this isn't a good scenario. So, are you really going to want to repatriate? Sort of, if you've been sat earning, 12-15% a year on Nasdaq for the last 20 odd years, are you going to want to change it, or are you going to accelerate the flows the other way? So, I just don't see the carry trade argument at all. I don't think it's an issue.
So you'd be a buyer of dollar yen on the dip.
I'd be a buyer of dollar yen, but again, like FX, like I still can see that there'd be reasons why the Fed would work with the Bank of Japan to help kind of smooth or control that FX sort of risk and volatility. I think it all leads to more money printing, probably benefits Nasdaq, S&P, probably benefits Bitcoin.
So let's talk a bit about this wave of liquidity, right? So, everyone was talking about government shutdowns ended, TGA's been built up, there's a load of liquidity coming, that's good for crypto. Hasn't happened yet. Is it just a case of it is going to happen, it just takes time for it to happen, and we might not see it until the new year? Or like, where is this wave of liquidity that people keep anticipating?
Yeah, well, I think there's a couple of things. So, as I've said, global liquidity remains quite high because you have this global rate cutting cycle. You have China as well that's still really pumping it. In fact, China now, we're back into seeing like the data deteriorate in China.
PMIs were softer, right?
Yeah, PMI softer. So they're constantly needing to stimulate. We've also seen like again kind of concerns around the property market.
Yeah, I saw that headline today.
Again, China just going to have to print and keep printing to
which is again supportive of global liquidity.
So global liquidity is rising. The issues lie in the US funding markets, right? And that in a dollar-based world, that is like at the heart of the whole system. And we spoke about before, like, so for me, it's like when you see the funding stress in the US, that's like we've got like a kind of clogged artery in the system. So even though the global liquidity is high, it's not flowing because of these funding issues in the US. Now, the end of the government shutdown, allowing the TGA drawdown, alleviate some of that pressure. But we initially saw like 100 billion drawdown, and it's kind of stayed there. Now, the offset to that is we're seeing a lot of treasury bill issuance, right? Because they need to fund this deficit. So that's kind of keeping the TGA like levels quite high. So whilst they're able to spend, they're also issuing a lot of T-bills to fund all that spending. So we've not really moved much in the TGA since the initial 100 billion drawdown.
So when they issue T-bills, that kind of means liquidity goes towards buying those T-bills.
Exactly,
right?
yeah.
It doesn't go into broader risk assets.
That every time you're issuing new issuance, you're sucking liquidity out of the market.
Right.
So you have that. You have that issue. The RRP obviously we know sort of tapped out. So QT ends this as of now. So we're not.
Yesterday,
yeah.
Right?
So that again alleviates some pressure because we're not.
But it's not an instant fix, is it?
It's not an instant fix. But the problem is, it still goes back to we've still got. We still ultimately need the Fed to come in and provide liquidity to fund this deficit because there's so much issuance that the market can't digest. And I say for the last 2-3 years, you've had the RRP money essentially drawing down to fund that. So that's been like pushing liquidity into the market. The Fed, they've already alluded to they're going to have to do some sort of monetary operation to essentially supply liquidity to the front end. If you look this week,
that's so that the issuance can keep coming without making rates go up too much.
Correct, basically. Yeah, and without putting too much pressure on the front end. This week, you're already starting to see again like front end spreads, front end rates are starting to widen out. So there's real pressure there. I think on Friday, which obviously was month end, but on Friday, it was a record take up of the Fed's standing repo facility. So essentially that's a facility where those institutions that aren't able to borrow from the market for whatever reason are then being forced to go to the Fed's SRF, standing repo facility, and borrow from there. And you pay a premium to borrow from there. So that tells you that there's these funding stresses and issues within the market.
Because the rates are going to get cut next week. That's at 87% priced in.
Yeah.
So if you needed to borrow money from the Fed, wouldn't you make sense to wait until next week?
Yeah, but you need cash now, right? You need to fund like your sort of daily operations and whatnot. Right. So I think long story short, there is still funding stress in the system, and you're seeing that show up in sort of front ends, like what we call SOFR spreads. And you're seeing it in the fact that people are being forced to go to the Fed's window, the standing repo facility. Now, what's going to happen is at some point, the Fed are going to basically start supplying sort of repo funding and liquidity into the market. And that's when I said I call it not QE, QE.
So that'll be an announcement.
Yeah. And the Fed's John Williams has kind of spoken in depth about this and what would trigger it. And I just, the worry for me is because they're talking about, we've gone from this thing of like this situation of having abundant reserves to now ample reserves. But once we start hitting that, that's when they're going to need to come in. Now, the question is how proactive will the Fed be in getting ahead of all of this? And right now, it just feels there's that tightness. And I still think that is the reason why crypto, and this has been happening really since October, and that is why crypto is kind of underperforming, because it's hypersensitive to liquidity. And I don't see until the Fed come in, like I can see us like recovering back to 100K or whatever, but as some of these stresses alleviate. But as we get into year ends, then you really start to see those funding stresses sort of start to blow out. So if the Fed don't act to get ahead of that, I do still feel that we're going to be under pressure in crypto. I think equities, because of that demand supply dynamic, can be okay. But crypto, I think.
But the rate cut next week, the rate cut next week doesn't really change that picture.
That doesn't change it that much, no. Because again, it's a choice between where you're lending your money, and it just means all rates come down. But
and what's this stuff about what Miran's been talking about on the banks and holding treasuries and things like that?
Yeah, so this all feeds like why I still think we're in a bull market, and we over the next year and into 2026 see,
because our friends at Real Vision have been talking about this as well.
Raul's been all over it.
So what's the story?
So the story is right. So I think firstly, like, we're going to see the Fed have to come in and supply some liquidity, but then there's this idea that the Treasury almost like wresting back control of monetary policy, if you like, or at least liquidity policy. But essentially, and we spoke before, they've already made adjustments to the SLR, the supplementary leverage ratio.
That's like how much they have to hold, basically, how much banks have to hold on their balance sheet.
How much capital, like for the leverage and assets that they hold, right?
Yeah.
So obviously that what that means is you're having to hold capital, which is expensive, right, against the amount of assets you've got, essentially. Now, treasuries are included in those assets that they hold and in the leverage, right? So they've adjusted some of those levels so that you require less capital. But Stephen Miran, who's obviously quite closely associated with the Trump administration, he's part of the Fed. He issued a statement to essentially say the new changes that will kind of alleviate some of those pressures that come in place from January. He basically come in to say that we should just remove treasuries altogether from that calculation, i.e. banks won't have to hold capital against their treasuries. Now, what that does is two things. Number one, it incentivizes banks to hold a shitload of treasuries, right? So that will look like, a kind of pseudo yield curve control, because all the banks will start wanting to buy up sort of, coupons and 10-year treasuries and further out the curve, because they're not having to put capital against it. Okay. So they can hold and earn that interest without having to spend capital to have that. The other thing it will do is it will obviously free up capital for riskier activity. So long story short, that's gonna unleash a wave of liquidity into the market if they do that. Now, that's a suggestion at the moment. It probably wouldn't get enacted until we had a new Fed chair in, I wouldn't imagine. So again, not an immediate thing. It's more about the announcement
that gets priced in, isn't it? Right.
So into next year, potentially, if they remove treasuries from the SLR calculation, into next year, you could have the Fed supplying liquidity into the front end, right? And then you have banks essentially buying up treasuries all along it. And that's going to look like a mix of yield curve control meets QE it's just going to be an absolute flood of liquidity.
So the US yield curve will just collapse, wouldn't it?
Yeah, or at least be like super stable, and despite all this issuance, and it's going to force everyone further out the risk curve. And that's where Bitcoin goes to like 250K, like like no problem.
Oh, wow.
So that's
punchy.
it is punchy, but like these are the games that are being played, and this is the thing.
But what time frame would you put on a move like that kind of move to 250? Could it do that in a year?
I still think so. Yeah, I think
that's like a tripling from here.
I think given how much
punchy.
I know, but we've kind of given up on the idea that Bitcoin can go up that much. But
True, and then it's reminded us how much it can go down, right? It went down 30% in a heartbeat. So, yeah, it's funny. Like the vol market does get quite complacent and just gets used to it doing nothing for ages, and it takes that entire pricing down the whole curve. So even back end vol, it doesn't feel very expensive for an asset that you're telling me could triple in a year.
Yeah.
Like long dated vol's priced at like 50 something, right?
Yeah.
So that doesn't make any sense, right? So if you're right, I mean, the type of structures you could put on, and I was talking about this earlier today with some of the subscribers of Real Vision that I do some work for, but basically you could do like a 6 month, you could do a June next year call spread. So not the whole year, but let's say June, you think there's going to be a big pop by June. You could do like a 120%, 150% call spread to June, right? And your payoff on that thing's 4-1 if it maxes out. So it costs you like X, and if it maxes out, you'll make 4X.
When you say 120%, what do you mean?
As in, like, we're trading at 85k right now, so 120% would be 100k. So like 100k, 130k call spread. Right? So percentage moneyness would be 120% of current at the money and 150% of current at the money. So the strikes would be roughly 100k, 130k. So you'd make a new high at 130k, right? If you think that happens by June, you do that call spread to June, middle of June, that will basically cost you, it'll cost you like 1/5 of the max payout, basically. It's not bad, right?
Yeah.
It'll cost you $4,000 to make 20,000, to make 30,000? No, sorry. Yeah, it's basically about 5 to 1.
5 to 1 payout. Yeah, interesting. What else is going on in the vol world?
So we had a bit of a vol spike, obviously, on the way down, but it's kind of started to mean revert a bit. So vol's kind of back to realizing implies are kind of equal right now. So Bitcoin's running at about 50, ETH's running at about 70. Ethereum front end vol has come in a bit. So, it was trading at like 25, 30 over Bitcoin. It's now about 15 in the front. So actually the absolute front has come down because they're both kind of moving together more. But Ethereum still holds quite a decent bid as you go further out the curve, right? People are still seeing that as the higher vol asset, understandably. Skew-wise, Bitcoin skew just continues to creep higher and higher into puts the further we go out the curve. So I think you're seeing like 3 or 4 vol put skew in the back end on Bitcoin now, and that's quite persistently there. So that institutional bid definitely wants long-term protection.
But you think that's the change in structure of the market rather than a view on Bitcoin?
Yeah. It's just any institutional money has to have long-term protection on now, most likely, right? And that's creating a persistent bid. Whereas the front-end skew is very much still chasing spot around. So at the lows, it was at like 10 vols for puts. Now that we've bounced a little bit, it's kind of about 5 vols. So that's kind of how Bitcoin looks. The front-end put skew just keeps bouncing between, say, 5 and 10. The back end put skew keeps creeping more into puts, but does it more slowly, right?
Yeah.
And then Ethereum, similar story to what it has been, which is front end, when Bitcoin dumps and ETH dumps with it, front end put skew catches a bid, goes to like 8, 9, 10 or whatever it is. But that back end skew just will not go into puts yet. It still manages to stay slightly into calls. So it's still thinking that Ethereum's got this massive repricing higher that could happen at some point next year. So they're just not willing to put a put premium on the back end just yet.
That's interesting.
Yeah.
Okay, and so like the idea of the call spreads, like the June call spreads, look obviously, given my directional view, looks interesting.
The nice thing about the call spreads in June is that it gives you leverage to your capital. It gives you an option that is going to hang around till middle of next year, which feels like a long time away in crypto land, right? And yet, if you're not convinced that we've hit the bottom yet, and this massive level on Bitcoin is like 74k, right? So it's kind of like, if you think we could continue to go down and maybe even break that level, and you're kind of worried that you haven't had confirmation that the bottom is in, rather than actually chucking a load of fresh capital into crypto here, the way you can participate is by holding some of those June call spreads and say, what am I willing to write off just to make sure if we do start going, I participate in the upside. But if we're still not done chopping lower, I'll hold my cash back for the major purchase that can come once I get confirmation. Right?
Now, for someone like me, that I'd buy that spread and I'd stick it in my bottom drawer and go touch grass, as the kids say. What about shorter term for more active sort of trader?
But short term, I still love these Ethereum call ratio type structures, right? They haven't made me any money yet, but they're just such a good, cheap way to get leverage to a bounce, right? Now, we need a bounce, though. We need a bounce to actually happen. We haven't really had a meaningful, sustainable bounce, right? But like those are the Christmas ones I was telling you about, right? Boxing Day expiry, something like a 36-41 call ratio. Right now, it probably costs $10 or $15. But if we get anywhere near that front strike, that thing's going to be worth $50 to $100 easily. Yeah. And you've made like 3 to 10x or whatever it is, right? Yeah. So, yeah.
And then what about anything you're looking to hedge downside?
I've been lightening up on hedges, right? I bought my short calls back. I rolled my puts into put spreads in December. So I'm just sitting on a bit of put spreads in December against my Bitcoin. Everything else I'm kind of leaving alone for now. Yeah.
I guess if the put skews normalized and there's less like attractive ways to hedge that, is that a reasonable thing to?
Yeah, I mean, I would argue, put spreads and put ratios don't look as good as they were. Yeah, true, given that put skew has normalized a bit. But like I said, I don't trade that front weekly skew that actively, right? Yeah. Generally, I park my hedges in the kind of 1 to 2 month bucket. And then as they start to get short dated into that sub 1 month, I'll think about rolling them out, basically.
Yeah. All right, interesting.
Yeah.
Okay, well, I guess like you can kind of draw things to a close there. I think that's the message from me as someone who's obviously long-term very bullish. I think short-term, until we sort out these funding issues, I think we're just in for a choppy kind of range-bound market into year-end in terms of crypto. I think equities can have its little Santa Claus rally, given that I think positioning is offside there and we'll have to chase that. Unless the Fed come out and proactively do something to address the funding issues, in which case I think we could have a really nice little ramp into year end. I think, just sort of buckle in for some choppy price action.
We could break this 74k support level, because I think if we break that, technically the picture looks horrible.
Yeah, I don't know. I kind of
possible though, right?
It's everything's possible.
Yeah.
Given like the flush that we've had, I find it difficult unless it's just continued selling from. But I don't think the wows are going to be selling like down at these levels.
Yeah, they're not gonna be like chasing it lower.
Yeah, not going to chase it lower, right?
Yeah, but they'll put a cap on it, won't they?
Yeah, so that's why I'm tempted to say like the lows are possibly in. But that said, if we start to see funding stress really blow out and the Fed don't react, then we could see another dump. I do think that's possible. So I definitely want to keep my downside hedged. But all this leads into us, I think, having to see the Fed come in and essentially print through monetary operations to really supply that liquidity. Going into next year, I think you're going to see all the kind of monetary games that are played to essentially fund this deficit. You're going to see Trump and Besant really pump the market into the midterms next year as well. So I still the
medium-term outlook is still very bullish.
I just think you've got to be really cautious while we've got this funding stress.
Yeah, exactly. So you probably don't go all in on loads of extra delta exposure here.
No.
But like I say, some of those longer-term call spreads probably aren't bad.
Yeah.
Make sure your downside doesn't look too horrific right now. And the wave is probably coming. You just got to be a bit patient for it, right?
Yeah.
All right, cool. We'll call it a day there. Hope you enjoyed the show. Remember, like and subscribe. Catch you back here next week.